Every broker who rated CSL a buy last week was technically right about the valuation and spectacularly wrong about the direction. That is the signal that cuts through today's session. The S&P ASX 200 closed down 42.6 points, off 4.9%, a moderate loss on its face. But strip out the healthcare sector, and the picture changes. Strip out CSL alone, and the day almost didn't happen. CSL fell 19% to $97.36, its largest single-day decline in the company's history. That is not a rounding error. It is a collapse that erased approximately $10 billion in market capitalization in one session. The company's interim CEO, Gordon Naylor, announced a fourth major guidance cut in 2 years. FY26 revenue now expected around $15.2 billion, underlying net profit cut to approximately $3.1 billion. The figures themselves were below consensus, but the additional detail was what moved the market. CSL flagged roughly $5 billion in additional pre-tax impairments across FY26 and FY27, on top of those already announced at the half-year result. The impairments target CSL Vifor's intangible asset portfolio, the product suite that was the entire strategic rationale for the $16 billion acquisition in 2022. Elsewhere in the session, Trump's rejection of Iran's latest peace proposal sent oil prices surging, reigniting Strait of Hormuz fears. Energy stocks caught a bid while the big banks traded lower. ANZ dropped close to 3%, though for a different reason, going ex-dividend after last week's half-year result and its 83-cent partially franked interim payout. The ASX 200's materials sector found buyers as gold held firm. The session's internal logic was not complicated. Geopolitical risk moved capital away from growth names and toward commodities, while a separate, domestic event delivered a wound the index could not absorb quietly. The question that the 19% number immediately raises is not what happened today. It is why nobody in the professional investment community appears to have seen it coming, not this time and not the 3 times before it. CSL listed on the ASX in 1994 at a split-adjusted price below $1. It compounded for nearly 3 decades. By February 2020, the share price had reached $342.75. The business built a global plasma therapies franchise, acquired Seqirus for influenza vaccines, and then made its largest bet, absorbing Vifor Pharma for roughly $16 billion to expand into iron deficiency treatment and nephrology. That acquisition closed in 2022, and the integration complexity that followed has never fully resolved. The Vifor thesis rested on a simple premise: a portfolio of specialty pharmaceutical assets in under-penetrated therapeutic areas, generating durable cash flows, would amplify CSL's compounding model. What it generated instead was a succession of impairment charges. The intangible asset base that justified the acquisition price, the product patents, the distribution relationships, the market exclusivity assumptions, has been written down progressively, and today's announcement signals the process is not complete. The $5 billion in additional impairments flagged for FY26 and FY27 are described as subject to further analysis, external audit, and board approval. That qualifier matters. It is an admission that the final number is not yet known. What makes this a capital flow event rather than simply an accounting adjustment is the broker consensus pattern sitting underneath it. Since mid-2024, CSL has shed over 2/3 of its value. Across that decline, broker consensus never moved to sell. Analysts repeatedly designated each leg down as a buying opportunity, each guidance miss as a temporary setback in an otherwise intact long-term thesis. Today, at $97.36, CSL is trading below $100 for the first time in approximately a decade, and the institutional framing that held the price elevated is now the variable under examination, not the product pipeline, not the plasma business, the framing itself. When a stock regarded as the ASX's most trusted compounding machine loses $100 billion in 2 years and brokers maintain buy ratings through each step, capital eventually prices the gap between the analyst narrative and the earnings reality. Today was that pricing event. The reversal insert is this: the plasma business, CSL Behring, is not the problem. Plasma collection volumes have stabilized, and the immunoglobulin business retains structural demand from an aging global population. If the market were simply pricing operational weakness in the core, a 19% single-day move would be excessive. What the market is now pricing is something different: the possibility that CSL's valuation model, the premium assigned to its perceived compounding durability, has permanently reset, not temporarily compressed.
The historical reference that frames today is not a neat parallel, it is a warning. Telstra spent the better part of a decade executing structural decline before the market fully abandoned the premium it had assigned to Australia's dominant telecommunications provider. The mechanism differed, competitive disruption versus acquisition integration failure, but the capital flow dynamic was similar. A blue chip designation suppressed the willingness to exit, allowing the valuation gap to widen before a sharp re-rating compressed it. Telstra eventually found a floor when the market stopped comparing it to its prior peak and started pricing it against its actual earnings base. CSL at $97.36 has not yet established whether it is at that point. Two conditions define the continuation case. First, the FY26 impairment total when finalized after audit and board approval must not materially exceed the $5 billion flagged today. A range expansion would signal that management does not have full visibility into its own asset base, which would reset the discount rate the market applies, not just the earnings forecast. Second, the plasma business must demonstrate sequential volume recovery in the next operating update. CSL Behring's revenue guided at approximately $15.2 billion for FY26 is not a collapse, it is a deceleration. If plasma margins hold while the Vifor write-down process completes, the argument that the core is intact becomes testable. The breakdown case rests on a different number. CSL at $97.36 is now trading at a price-to-earnings multiple the market has not assigned to the stock in over a decade. That derating can continue if institutional holders, superannuation funds, index replicators, long-only healthcare mandates, decide that a stock that has fallen 19% in one session and lost two-thirds of its value since 2024 no longer belongs in the same portfolio sleeve as it occupied at 342. The ex-dividend rotation in ANZ today, the stability in materials, and the energy sector's performance all suggest capital inside the ASX is moving, not leaving. If healthcare funds begin rebalancing out of CSL and into the names that held today, the selling pressure extends beyond today's technical move. The verification benchmark for tomorrow, watch CSL's opening volume. A stock that opens and grinds lower on thin volume is finding sellers with no urgency. That is continuation. A stock that opens lower, absorbs volume, and recovers intraday is finding buyers at these levels willing to test the core business thesis. Neither outcome confirms the direction, but the volume pattern establishes whether the 19% move exhausted sellers or merely started them. What would invalidate the floor thesis entirely is a second guidance downgrade before FY26 results are finalized, which is the question that Gordon Naylor's 90-day interim review left open rather than closed. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.